3 years from now, you're going to look back at something you're excited about today and realize you were late. Not foolish, not reckless, just late. Late to crypto, late to AI stocks, late to whatever just doubled while you were waiting for it to feel safer. Right now, somewhere in a Discord server you've never heard of, people are quietly building positions in something that hasn't made a single headline. In 5 years, someone on your feed will post a screenshot, and your first thought will be, I knew about that. The painful truth? Most people don't lose money because they pick bad investments. They lose money because they pick good investments after the asymmetric upside is already gone. By the time it finally feels safe enough to enter, the math has already flipped against you. This isn't bad luck. It's a structural trap, a predictable cycle. And once you see how it works, you cannot unsee it. Financial trends don't start on your feed. They start in obscurity. In 2009, a handful of programmers were passing around something called Bitcoin. No headlines, no panels, just risk and silence. By 2013, analysts started paying attention. By 2017, your Uber driver explained it on the way to the airport. That moment, when it finally feels obvious, when everyone's talking about it, when not joining feels irresponsible, that's not a green light, that's a warning bell. Every major financial wave follows the same 4 phases. Phase 1, quiet accumulation. Specialists move in. Prices are low. Uncertainty is high. Nobody's watching. This is where the real asymmetric money is made, and almost no one is there to make it. Phase 2, institutional validation. Analysts build narratives. Media attention grows. The story sounds reasonable. A few early retail investors start to notice. Phase 3, mass awareness. Influencers, headlines, screenshots of gains. It shifts from interesting to obvious. You feel behind. This is where most people enter. Phase 4, saturation. Everyone who can buy has bought. New buyers slow. The only fuel left is optimism, and optimism runs out. Markets don't crash when things are bad. They crash when expectations can no longer go higher. Most people don't enter in Phase 1. They enter in Phase 3. Not when it's uncertain, when it feels obvious. Think about Marcus, software engineer, smart guy, careful with money. He'd heard about crypto for years and thought it seemed speculative. Then, in late 2021, his coworker wouldn't stop talking about it at lunch. His brother-in-law texted him a screenshot of his portfolio. His feed was full of it. So Marcus finally moved $22,000 in November 2021. 12 months later, that $22,000 was worth $4,800. Marcus wasn't dumb. He was just late. Your brain confuses repetition with safety. The more you hear something, the more real it feels. That's not analysis, that's exposure. And here's the irony that costs people everything. The louder an opportunity gets, the smaller the edge. Markets reward uncertainty. They punish consensus. If everyone agrees something is the future, the price already reflects that belief. Markets price in expectations, not excitement. Here's exactly where the damage happens. An asset rises from $10 to $100. That's a 900% gain. Early investors took massive uncertainty and were paid for it. But if you buy at $100 hoping to reach $200, you're risking serious capital for a possible 100% gain while facing a 50 to 80% drawdown if it normalizes. Same asset, different timing, completely different risk structure. Early buyers had asymmetric upside. Late buyers absorb asymmetric risk. That gap is where wealth transfers, quietly, legally, and at massive scale. Not through scams, through timing. Trend chasing doesn't just create drawdowns, it interrupts compounding. And compounding is the entire engine. $10,000 at 9% annually becomes roughly $86,000 in 25 years. That's not hype, that's optionality, that's breathing room. Now compare that to chasing 3 major trends in that same period: entering late, selling in fear, sitting in cash during recoveries. Same $10,000, after fees, mistimed exits, and emotional decisions becomes closer to $28,000. You didn't lose everything, you just lost the compounding window. Money can recover, time cannot. Every year inside the cycle is a year compounding didn't run. And the system is designed to keep you in the cycle. Algorithms reward engagement. Engagement rewards extremes. You see the person who turned $5,000 into $500,000. You don't see the thousands who tried and quietly disappeared. Survivorship bias becomes content. Content becomes strategy. No one profits when you quietly index for 30 years. Patience doesn't trend. Activity does. So activity gets amplified. The truth is almost too simple. Own productive assets broadly. Keep costs low. Add consistently. Increase risk only when your timeline supports it. When something explodes into public consciousness, ask one question. Who already made the asymmetric money here? If the answer is insiders, venture capital, institutions, and the chart looks vertical, you might not be the investor. You might be the liquidity. The people who build real wealth aren't the ones who caught every wave. They're the ones who stopped trying to. Every decade has its mania. Right now, in 2024, there's a new one forming. You probably already feel it. Something that's moved from fringe conversation to mainstream excitement faster than anything before it. The question isn't whether to participate. The question is whether you're building your financial life reacting to noise or compounding quietly while everyone else chases the next headline. 3 years from now, you'll look back. Were you building wealth or providing it to someone who entered earlier? That decision doesn't require genius. It requires the discipline to be boring when the whole world is being exciting. Most people will watch this and go back to chasing. If you're not most people, subscribe. And if someone you know is stuck in the cycle, share this with them. It might be the most valuable thing in their feed this year.